Last week, the EIA forecast a drop in U.S. oil demand in the year to come, and this week, OPEC decided not to adjust its production levels amid international demand concerns. Now, the American Petroleum Institute is issuing its latest report on the oil sector. With us now for a deeper analysis of that report is John Felmy. He is the chief economist at API. John, thanks for joining us at a date that is so close to Christmas. So many people are leaving town. Glad you're here with us today.
Thanks for having me.
The headline you were telling me in this report is the fact that this is changing. However, this is something that's expected through usual trends, correct?
Well, this data is highly seasonal, and it's seasonal by week. So it's a function of vacations, holidays, and so on. And so historically, for the week that we just reported on, you see crude stocks down, distillate stocks, which is primarily heating oil, down, but gasoline mixed. And that's what we saw pretty much yesterday.
No outside influences for the most part with the OPEC decision this week, unlike a year ago when a change in production levels had such a drastic effect on prices. Do you see stability going forward for the most part?
It's really going to depend on the world situation. I mean, most of the forecasters are saying that we're going to see a growth in world demand up to back over 86 million barrels a day. We'll have to see that happens. That's going to be a function of the economy, weather, how cold it's going to be, because it's quite cold in Europe and the United States right now.
Our own Dee Bombane reported on the EIA's most recent forecast and outlook, saying that oil demand, at least in the near term through next year, would be down just a little bit. Do you recall ever seeing oil demand so closely tied to the economy and a recovery as it is right now?
Well, historically, I tend to look at some magnitudes in the demand numbers, particularly low sulfur diesel. The correlation historically between low sulfur diesel demand, which is primarily used in trucking, and GDP is very high. It's as high as 0.96. We've seen that the demand for that product, low sulfur diesel, has declined less, but it's still declining.
But that is an effect of the economy, correct, in the recovery?
Absolutely, because everything's shipped. Similarly, for example, business travel is tied to jet fuel demand, and that's showing the same decline. It's down less than it was.
While we're talking about fuel and transportation, John, there's been much talk, especially this week, over the disparate numbers between gasoline prices right now and oil prices themselves. Where do you see them, and what needs to change, one end or the other, potentially?
Well, historically, the relationship between crude oil prices and gasoline prices moves very closely. We've seen historically, over the last 10 years or so, the difference between crude oil prices in cents per gallon and retail prices was around 97 cents a gallon, and about half of that is taxes. Right now, we're seeing crude oil yesterday closed at about $1.77 a gallon, or 74 a barrel, and gasoline is about $2.65. So you've seen a narrowing, which tells you that there's lower margins in the supply chain.
Is that also seasonal as well, especially with gasoline prices?
It does vary because it's a function of demand. If you've got more demand, then it tends to tighten the market some.
Right. Since we're wrapping up the year here, does it surprise you how different the picture is right now versus almost exactly 1 year ago? We were looking at such lows, more than half below what we are right now.
Well, a year ago, we had crude oil prices about $40 a barrel, and they're now
toward 32.
That's right, heading toward 32. And we saw gasoline prices at about $1.69, so less than $1 more. So again, the relationships were still there in terms of the cost of producing the gasoline product, but demand was so much lower that you had crude lower.
But when you look at where we were a year ago in July, so 18 months ago, and the record high at 147, and such a precipitous drop so quickly, is it fair to say we're balanced out right now? We're about where it needs to be?
Well, it's hard to say. If you look at inventory levels worldwide, they aren't changing much. Yes, they're higher in the U.S., but if you look at world levels of inventories, at least as much as we know, you don't see a big buildup, which suggests that you have an equilibrium of supply and demand.
If you could pull back just a sec, John, to your role as an economist and take some of the fossil fuel background out of it if it's possible, is oil being driven up or stabilized to some degree by the weak U.S. dollar or the relative strength of the dollar right now as a haven for investors?
Well, on a day-to-day basis, clearly you see those movements. But when the contracts close, as a participant, you either have to make or take delivery, roll, or whatever.
Right.
So in any case, then it's what happens with inventories at that point. And if you look at the inventory changes, you don't see big builds, which would imply supply greater than demand, or big draws, the reverse. So it suggests that it's fundamentals.
The glut seems to be gone here in the U.S., something we were dealing with for much of the year. Is it gone for good? Not permanently, but at least in the near term.
Well, it's going to be a function of demand, which is going to be a function of the economy and weather. We clearly have seen inventories are down from what they were for crude. They're still quite adequate in terms of gasoline and distillate. So we'll look out forward and see what happens with the demand and supply conditions.
Well, what do you see in 2010 as we go forward? Again, this is a traditional time to wrap up the year in review, but let's look ahead now.
It's really going to come down to all those factors we've just talked about. You know, I like to say if I could forecast the price of oil, I wouldn't be sitting here. I'd own Maui.
Yeah, you may be sitting here as an analyst, however, a private sector, but what are you looking at? Let's talk in general terms, though, without making a prediction, the trend you see for the year ahead.
Well, I look at what the major forecasters are saying, and that is, for example, if you look at the IEA, the EIA, OPEC, and others, they're showing a demand growth. Now then the question is, will that be met by supply? Otherwise you've got a tightening market. And the supply is going to be very much a function of OPEC behavior. OPEC has clearly held to their quotas by about 80%, now maybe 60%. And so it'll be a function of that along with some of the new discoveries that are coming online. And that's far too many factors. As I like to say, it's a cloudy crystal ball.
Is it possible to overplay the role of China? We reported within the last week that demand over 1 year has gone up something like 19% from December '08 to December '09.
It's really hard to overplay a country that is buying more automobiles than the United States, because that's really a powerful demand increase that you don't see abating in the near future.
All right. John Felmy is Chief Economist with API. If you haven't noticed, he has his Penn State tie on today, and I'll spare you a prediction unless you want to look into the cloudy crystal ball.
Go Lions. We are Penn State.
Safe enough, John. Thanks so much and enjoy the holidays. We appreciate it.